You walk into a store. Two products. One's $10, the other's $1,000. Which is the better deal? If you said the cheaper one, you just failed the investor's test. Because in the stock market, cheap isn't cheap, and expensive might just be a once-in-a-lifetime opportunity. For years, the market rewarded hype. Meme stocks, crypto pumps, AI buzzwords. People thought they were investing, but really, they were gambling with better lighting. Then, reality hit. Stocks crashed, portfolios bled, and suddenly, valuation wasn't just a buzzword, it was survival. But here's the real trap. Most people still don't know how to tell if a stock is actually worth buying. They chase big names, like Berkshire Hathaway or Coca-Cola, thinking price equals value. Or worse, they buy a stock at PE 100, thinking it's a bargain, just because everything else is PE 2000. That's like saying a $100,000 dog is cheap, because you sold your $200,000 cat. You wouldn't buy a Ferrari for $100,000 without knowing what condition it's in, would you? So why would you buy a company without knowing its engine, its earnings, its future, and its margin of safety? Peter Lynch had a model. So did Buffett. So does every serious investor who's ever survived more than one crash. These models ask three simple but powerful questions. How much cash will this business generate? When will I get that cash? How sure am I that I'll get it at all? That's not just stock picking. That's business ownership thinking. Because the stock market isn't just numbers. It's human psychology baked into valuation formulas. So how do you actually value a stock like an investor, not a gambler? Here's your three-step playbook. 1. The relative check. Look at the stock's PE ratio. Then compare it to its peers and its 10-year history. If everyone's overpaying in a bubble, don't let a lower PE fool you. Sometimes cheap is just less stupid. 2. The intrinsic value test, DCF. Estimate how much free cash flow the business will generate for the next 10 years. Then discount that at a rate that reflects reality, not fantasy. Buffett often used the 10-year Treasury yield plus 3%. If a stock doesn't give you a margin of safety, walk away. 3. The business filter. Is this business simple, stable, and predictable for the next 15 years? Buffett avoids complexity. He wants peanut brittle, not rocket science. You don't need a CFA. You don't need Wall Street connections. You just need to stop thinking like a consumer and start thinking like an owner. Whether it's Coca-Cola, Tesla, AG Barr, or Ford, every stock tells a story. Your job is to read it with clarity, not emotion. As Charlie Munger said, if you need to use a calculator to justify the investment, it's probably too close to call. Great investments should scream at you. So here's what I want you to do. Think about one stock in your portfolio right now. Is it cheap or just popular? Drop a comment with the stock you're most confident in and why. And if this video gave you clarity in the chaos, hit that subscribe button. The market may be noisy, but your strategy doesn't have to be.